Welcome to the fascinating world of equities investing. As a financial expert with over 2 decades of experience, I'm here to guide you through some key concepts. We will cover 3 key measures of risk for an investor. 1. Sharpe Ratio. 2. Concentration risk. 3. Volatility. Let's start with the Sharpe Ratio. It's a measure used to assess the risk-adjusted return of an investment or portfolio. In simple terms, it tells you how much excess return you're earning for each unit of risk you take. A higher Sharpe ratio indicates better risk-adjusted performance. It's a tool that helps you evaluate the return potential of an investment relative to its risk. Ideally, you want a Sharpe ratio of over 0.7 because an index like S&P 500 or Nifty 50 has a ratio around that. However, achieving a Sharpe ratio of over 1.5 is quite challenging for a long-only investor. The goal should always be to improve this number. Let's now talk about the drawbacks of Sharpe ratio. 1. The Sharpe ratio heavily relies on historical returns and volatility, which may not accurately predict future performance. 2. Changes in the risk-free rate can significantly impact the Sharpe ratio, making comparisons across different time periods or portfolios challenging. 3. The Sharpe ratio assumes that returns follow a normal distribution, which may not hold true in real-world scenarios. 4. It does not account for nonlinear risks such as extreme events or tail risk, which can have a significant impact on investment outcomes. Next, let's delve into concentration risk. This risk is associated with having a significant portion of your portfolio invested in a limited number of assets or a specific sector. If your portfolio is heavily concentrated in a few stocks or sectors, any adverse events or poor performance in those assets could significantly impact your overall portfolio. Diversification across different assets or sectors helps reduce concentration risk. This spreads the risk across a broader set of investments. If you have 20% tied to one stock, then you could face a 15 to 20% loss in the worst-case scenario. It's wise not to put more than 5% concentration in a portfolio. Finally, let's discuss volatility. It refers to the degree of price fluctuations in the value of an investment over time. It's a measure of the uncertainty or risk associated with an investment. Higher volatility indicates larger price swings, suggesting greater potential for both gains and losses. A typical mega-cap name like Microsoft has a volatility of 20 to 30%. However, a small-cap name could have it as high as 100% or more. Therefore, it's crucial to be prudent in deciding how much money to invest in each name. Now let's also see some other measures of risk. Value at risk, VAR. VAR estimates the maximum potential loss an investment or portfolio may face over a specified time horizon and at a certain confidence level. Conditional value at risk, CVAR. CVAR, also known as expected shortfall, goes beyond VAR by measuring the average loss beyond the VAR threshold. It provides additional insights into the tail risk of an investment. Downside deviation. It focuses on the negative fluctuations or downside risk of an investment. It provides a measure of the volatility of negative returns, offering insights into the potential downside risk. Maximum drawdown. Maximum drawdown measures the largest peak-to-trough decline in an investment's value. It indicates the historical downside risk and the potential loss an investor could have experienced during a specific period. Remember, knowledge is power, especially when it comes to investing. Thank you for listening to Xstocks.